Okay, guys, welcome back. And today we have to discuss a new chapter that is Introduction to Cost and Management Accounting. Cost and Management Accounting. And this chapter we will discuss about a double entry bookkeeping and then financial and management accounting, then computerized systems, then purpose of management information, then limitation of management information. And at last, we will discuss the conclusion that what we have actually covered in this chapter. Now, the chapter number 1, 2.1, there are subsection that is your accounting equation, that is also the topic. And then in the next lecture, we'll discuss about double entry principle, then general ledger entry accounts and differences that is related to chapter the subsection of the 2.2 of financial management accounting, and then bookkeeping, computerized accounting software, then purposes and management accounting information, and so on, like this. Clear? So before we have to start this section that is accounting equation, I want to explain this before we read what actually there are in the paper, or you may say like in the SCCS rehab. Okay, so the first thing is that accounting equation, which is the foundation of accounting. This is actually the foundation of accounting. Okay, and this accounting equation, I will write here, there will be an asset, there will be in liabilities, and plus owner equity. So this means that this accounting show the relationship or between what a business actually owns, that is your asset, and what it a business, and this will be own, this will be owes, that will be your liability. And the third part, that is what belongs to the owner, and that is your equity. Clear? So what actually I'm trying to explain that accounting equation is basically the foundation of accounting. This is the basic where the accounting stand. So there is an asset, and the asset will be comprised of the liability, the money, the stuff you owe from other, and the owner equity, that is the part of the owner that they have invested, okay, and their business. So okay, fine. Now the relationship, this accounting equation actually show the relationship between what a business own, that is your asset that you see here, what it business owes, and that is your liability that you need to pay in the future, and what belongs to the owner, and that is the equity, that is the amount, that is the stock that the owner have invested. Oh, clear? Now, if we let me scroll it down. Things not working. Okay, fine. Let's move on this way. Okay, yeah. Okay, fine. Now we have actually said that there is asset. By asset, we means that the things that business business owns, and that have values too. Okay, that have values too. So the things that a business own and that have values, it means that as the asset of the business. Okay, and now these asset is used by the business for what? For generating income, for generating incomes, or helps to run the business. Okay, an example will be like your cash, like your inventories, or like your billings, like equipments, and so on, like that. Clear? So things that a business owns and that have values, and these things are used by the business to generate generate income for the business, or it may help in the business to run, to operate, then we call that as asset. Those things will be your asset. Clear? Now the second part of the equation, the second component of the equation is liability, and liability is what the business owes to others. So what the business owes to others, What does it mean? It's mean that your debt or your obligation that the business needs to pay in the future. So that is your liability. It means that debt or obligation that the business needs to pay in the future. So that is the liability, and that is the component of the accounting equation. Clear? Now the example for this is your bank loan. Okay, fine. This is the unpaid bills, and so on like that. Clear? And now let's discuss the third point. That is your equity. Equity, and equity is actually the owner claims. The owner claims on the business after all liabilities are paid. So that is the part of uh, the business when all liability paid, and there are some left things that the owner claim that, and that will be the equity. Okay, so this equity represent actually the owner investment in the business, and any profit kept in business, that will be your equity. So I will say like here that equity is actually the owner claims on business, but when after all liabilities are paid. So this means it represent two things. Number first, owner investment in business, plus any profit kept in business after paying the liability. So there will be a profit amount, and that will be the owner claims. Clear? Now let me show you how does this work. Okay, how does the equation work? How does this equation actually works? So there is asset, liability, and owner equity, and we have discussed this in a very details. Now the business, means that the business own, mean the asset is either financed by borrowing money, that is the liabilities, or by the owner investment, that is your equity. You understand what it means? It means that these assets are either financed by borrowing money, that is the liability, or by the investment by the owner, and that is equity. So this is all about accounting equation. Now we have some other term that we need to explain before we actually read the study of stuff, and that is your income. The term income you will see many times in this book, and you will see again and again. So this is actually the money, and you can say there's another word that is revenue, which is interchangeable use for this. So the money business earns from selling goods or services, then that will be your income, and that will be your revenue. The other terms, that is your expense, and expense is actually the cost a business incur to earn income, and that is for the help of the operation of the business. And when you do some operation, then definitely you earn the income. Clear? Now let's give an example, and then we will move to that stuff. So let's say you have invested $100. Okay, so this is your equity component, and you have also borrowed let's say 50, that will be your liability. So the total asset will be $150, and the equation will be like this: asset is equal to liability plus equity, and that is 100. Oh no, sorry, there is 50 plus, and the equity was 100, so the total asset will be 150. Now let's move on to the actual book material or the study hall material. Fine, here. Now, now you will see here, there is, let me zoom it out, so you will see now. Okay, fine. Okay, now let me show you here, the screen you see here, that the accounting equation represent a relationship between assets, liabilities, and owner equity. Asset is equal to liability plus equity. Clear? And we have discussed this in every detail. Now let's check what actually the actual definition of asset. Asset is a resource that is controlled by a business. Now asset is a resource, okay, and this resource is controlled. So this is the first thing. By business due to something that happened in the past from which economic benefits, mean things that make the company better or financially, are expected to flow in the future, and that will be your asset. So asset is actually a resource that is controlled by the business, and this control come through something happened. There's some activity, some event happened in the past, and for that reason you are now controlling these resources, and you are expecting that you will get some benefits, or you are expecting that the benefit will flow to you in the future, then that as your asset. So you are actually getting or expecting benefit from these resources. So resource, okay, fine, controlled by the business, fine, and this control comes because something happened in the past and from which you are expecting economic benefit. The economic benefit means that your company will get better financially, or you maybe get you are expecting something that will favorable for your company, so that will be your asset. Now let's talk about the liabilities. So liability is actually the amount owed to the business arising from the past event. So this is the amount that you have to pay, and this is the favorable for the business, and this happened because of some events that happened in the future, in the past, and because of that you have an obligation to pay that amount, and that is your liability, which result in the payment of money at some point in the future. So you have to pay some money in the future, and this happened because of the past event and create obligation for you. Now a liability is effectively opposite to an asset. So an asset, you are expecting the economic benefit that will flow to your company, to you, and liability, you are expecting the outflow of the economic benefit from your company. So this is actually effectively opposite to the asset. Now, third term, that is equities capital. So the owner interest in the business, that is called capital. It is made of cash or asset introduced into the business by the owner, known as capital introduced. So capital is actually the owner interest in the business, and this is made of cash. It may be cash or asset, and introduce that cash or asset into the business by whom? By the owner, and that we call as capital introduced. Now the profit generated by the business and the previous year less any amount that the owner has withdrawn from the business, mean called, let's say you have invested $100 in this business, so that will be your equity, your capital. And if you are withdrawing some, let's say you are withdrawing 50, so that will be drawing, and that should be deducted from the equity. But because you're reducing your capital, why you're reducing? Because you are drawing, you are removing the money, so that is your drawing. So actually say that the profit generated by the business, okay, and the previous year less any amount that the owner has withdrawn, mean drawing. So the profit less the previous year profit less drawing. And capital may also be defined as the value of the asset which remain after liability have been met, as shown in current equation below. So it actually says that the capital, or actually the amount left in the business after deducting all the liabilities, that is the actual interest of the owner. So you may also say that profit after drawing, that will also your equity. You see here, the profit generated by the business and the previous year less any amount that the owner has withdrawn from the business is known as drawing. So it's defining that the amount owner has withdrawn the money from the business, that is called drawing. Now I will show you here. This is the asset less liability and capital. So this is the actual equation that you have to understand. Clear? Let's move on. Yeah. Okay. Now you see here. Okay. If you see here, these are the example. The first one is asset. You see cash. Non-current asset, that is that will be your building, your equipment, etc. Receivable, the amount that are expecting that you will receive in the future. Inventory actually is the stuff that you are actually trading with that. It may be supplies, like if you are doing a business of soap, you are doing the business of crops or any other things, then that will be your inventory. Prepayment, that the payment that you have actually made free me before. So before it will, this is your asset because this amount is not yet consumed. Now, liability, on the other hand, is the trade payable, the amount that you will pay in the future. That may be loan, accrued expenses. On the other hand, you will see capital, so that will be reserve, retain, earning. These are just the examples. Okay. Now, let me show you something. The accounting equation guides the following interaction. Any changes in one of the component will affect either the same component or the other. So actually saying that if this is equation, asset is equal to liability plus equity, so it means that any change in one of the component will affect either the same component. If there's change in one component, it will affect either the same component or you see an example. Increase in the asset could lead to decrease in another asset, or increase in the liability, or to increase in the capital. So if you increase the asset, let's say increase in the asset could lead to decrease in another asset. If you increase the asset, let me show you here. Let me show you. If you have cash, fine. And if you are using these cash for purchasing inventory, okay, cash is also asset, inventory is also asset. Now if you are spending to purchase this, so it means that you are decreasing the cash and increasing the asset. One thing. Okay, fine. Now in another case that increase in asset could lead to a decrease in another asset. This is the first case. You see here, increase in one asset means increase in the inventory can decrease the another asset. You see now, increase in the liability or increase in the liability. Now if you have not paid this in cash and you are just this is by the credit transaction, that it means that create liability, and liability as your payable, payable, and that will be your liability. So when you are increasing the asset, fine, then it also increase by liability because it's a credit term, you are purchasing the thing on credit. Clear? Now or increase in the capital, it will also increase in the capital. So this is actually saying that these any changes happen in one of the component can also affect some other component or others, same component or other component. Now the accounting equation must always balance. Okay, this equation should be balanced, must be balanced, and means any change in one component must lead to equal opposite changes to accept or another element. So this means that if anything happen in one side, this will also affect the another side by the same amount. Clear? Now let me show you here. If okay, wait, let me here. You see example. If $100 of cash mean asset is used to buy inventory, also an asset, and the cash balance will reduce to 100. Fine, because you are purchasing or buying the inventory. Now the inventory balance will increase by $100. So if in one side you are decreasing the asset, that is cash, the other side you are also increasing the inventory, that is your also asset. So balancing the equation, by 100 one decrease, by 100 one increase. Now another example, if 100 of cash mean asset is used to pay a loan liability, so the cash balance will reduce to 100 because the cash you are paying your loan, your liability, and the loan balance will decrease by 100 because you are paying it. So that is the balancing of equation. Now let me show you some other term that we have also discussed that about withdrawing, that the amount that a business owner withdraw from their business. So the withdrawals from the business by the owner, so that is called drawing. So decreasing in capital and asset. For example, owner withdraw $100 from his business, the reason for reduction in the cash balance mean asset and a capital of this amount. Now another word that is income revenue, that both are interchangeable. Amount, but there are some slight differences because we are not diving to that, but we have to look at this like these are interchangeable words. Now income and revenues on from selling goods services, so increase in the capital uh, amount on by from selling a good service. So this increase in capital and asset because you are getting the profit, you are getting the income, the cash. So a receivable, that will be your asset. So the business sell goods to customer by 100 in cash. So this increase cash, asset, and the sale capital by this amount. Now if a goods was sold on credit, this is the case of receivable. The asset is also increased and the sale capital by this amount. Expenses is the amount that the business incurred from purchase for services, and that is for the operation of the business, to run the business. That will decrease the capital with the corresponding decrease in the asset and increase in the liabilities. So, for example, a business paid its electricity bills, well, that is 100 in cash. So that's decreased cash. Okay, fine. And asset and the capital by this. So expenses anchored on credit. So means create a liability, that is called increase in accruals, that liability by $100 and decrease capital by 100. So let me expand this equation. You see here, this is expanded form of the equation. Asset is equal to capital plus income less expenses, that is the net amount, less drawing, and that will be liability. So after adding capital plus income minus expenses minus drawing liability, then that will be your asset. Clear? This is for today. Inshallah, we'll continue in the next lecture, and that will the topic will be the double entry principle. So thank you for watching.